All right, welcome back to the deep dive. Today we are strapping on our analytical hats and diving into a single, and I have to say, a highly unusual stock.
It really is.
We've been handed excerpts from a pretty dense technical analysis report on a company called NCL, and what it reveals is, well, it's a genuine contradiction.
A complete standoff. You have these overwhelming bearish structures on one side, and on the other, just the first whispers of a potential relief rally.
That's our mission today. We want to move past the financial jargon, the SMAs, the RSIs, all of that, and really distill the story these numbers are trying to tell you.
Then we have a clear starting point. The report says NCL closed recently at Dorville 3.15 cents.
Which basically confirms it's in a significant and probably painful downtrend.
Exactly. And that price gives us our framework. We have to acknowledge just how deep this bear market is. I mean, the data insists on it. But we're not just here to state the obvious. We're hunting for signs of exhaustion, maybe some short-term potential, and I think most importantly, trying to understand what is driving this stock's really unique volatility. The report flags it as highly unusual.
Okay, so let's unpack that. Where do we start? The most traditional sign of trouble has to be the moving averages, right?
Absolutely. They're the clearest place to begin.
These averages, they're like the stock's historical equilibrium. And when the price is trading this far below them, those lines immediately flip from support to just massive resistance points overhead.
And to really grasp the scale of the damage here, you have to compare the current price, that 0.315, to its historical benchmarks.
So what are we looking at?
Well, the price is currently trading about 30% below the SMA 50. That's the medium-term average, sitting up at 0.447.
Wow, a 30% gap. That's a massive deficit. It sounds like the selling has been going on for a while.
It's been sustained and persistent. And a 30% gap is a steep, really energy-consuming climb just to get back to what was an average price a few months ago.
That's just the medium term. What about the long term?
Right. And that's the number that truly confirms the report's language. It calls this a deep, long-term bear market, and the SMA 200 tells you why.
Okay.
That sits all the way up at a $1.73.
$1.73.
Exactly. Think of the SMA 200 as, I don't know, the stock's baseline health level. The current price is less than a fifth of that long-term average.
So the sheer distance between 30 cents and $1.70 tells you this isn't some short-term dip. This is a foundational structural crisis in the stock.
It's the big picture, absolutely.
So if those long-term averages are just screaming pain, what is the absolute minimum NCL needs to do to even signal it has a pulse in the short term? What's the very first hurdle?
The minimal requirement is just to get above the SMA 20. That's the short-term average, and it's sitting right at 0.3335.
33.5 cents.
Yes. If the stock can't even get above that level, all the other short-term signals we're about to talk about, they're basically invalid. It's the first floor of the recovery building, so to speak.
So we've established the price is severely depressed, resistance is massive. Now let's pivot, because for me, this was the most critical piece of information in the whole deep dive.
I agree.
This is where it gets really interesting, because it fundamentally redefines the risk here. We're talking about the beta coefficient.
This is the key. This is what makes NCL different from, 99% of other stocks. Beta measures how sensitive a stock's price is compared to the overall market, like the S&P 500.
Right. So a beta of 1 means if the market goes up 1%, the stock goes up 1%. Simple.
Yep.
But NCL's beta isn't positive. It's way down in negative territory.
Precisely. Its specific beta coefficient is minus 0.824. And a negative beta is highly, highly unusual.
And what does that mean in simple terms?
It implies a strong, consistent, inverse relationship. So when the broader market is doing well, when it's rising, NCL tends to go down.
That's bizarre. So it's completely ignoring macro trends, global economics. It's just marching to the beat of its own drummer.
That is the best way to put it. This negative beta tells us the stock is driven almost entirely by what analysts call idiosyncratic risks.
Company-specific risk.
Exactly. We're talking about internal operational failures, maybe specific regulatory hurdles, a product failing a clinical trial, a major lawsuit events that are completely unique to NCL.
This changes the entire context for the analysis then. We know it's bearish, but now we have a good idea why it's bearish. It's because of unique company problems, not because the whole market is collapsing.
And that makes predicting its next move far, far harder. For a technical analyst, a negative beta stock is a real challenge because all the traditional correlations just they disappear.
So you can't just look at inflation data or Fed decisions.
NCL just won't care. For you, the listener, this means when you look at NCL, you can't just rely on market news. You have to find out the specific internal company details driving the sentiment. That negative beta is a flashing warning sign.
That's a vital piece of context. Okay, so now that we know the risk structure, let's look at the current momentum, the energy levels in the stock right now.
Yeah.
Things like the RSI and the MCD.
Okay, starting with the RSI, the Relative Strength Index, it's sitting at 44.16. Just as a reminder, above 70 is overbought, below 30 is oversold.
And a 44.16 puts it in that neutral to bearish zone, right? Between 30 and 50.
That's it. So it's not deeply oversold anymore. The immediate panic selling that probably drove it below 30 has eased up.
But it doesn't have the strength to suggest a real move up is starting.
That's the key takeaway. It has recovered from the abyss, which is good, but it has none of the energy it needs to get into that bullish zone above 50. It just suggests indecision. The sellers have paused, but the bulls haven't been able to take control.
Sellers still have the edge.
A slight tactical edge, yes.
And what about the MCD? The moving average convergence divergence. It's at minus 0.060, so that confirms the downtrend.
It does.
But the report advises us to watch it very closely for a crossover. Why?
And that's where the nuance comes in. While the MACD is negative, confirming that slide, the lines themselves are converging. They're getting closer together.
Okay, so the rate of the downward move is slowing.
Exactly. The sellers are getting less aggressive. If we see a bullish crossover where the MACD line crosses above the signal line, that would be a critical piece of evidence. Much stronger than what the RSI is showing us now. It would suggest the short-term trend has definitively reversed.
Got it. Okay, speaking of movement, let's look at volatility. Bollinger Bands. The report says the price is trading between the lower and the middle bands.
And just the sheer width of those bands confirms what we already suspect. NCL is an incredibly volatile stock. It lines up perfectly with that high idiosyncratic risk we saw from the negative beta.
And the middle band.
The key technical coincidence here is that the middle band is sitting at 0.335.
Wait, that's the exact same level as the SMA 20?
The very same. So now you have two completely different indicators, one for trend and one for volatility, both pointing to 0.335 cents as the single most critical stabilization point. Getting above that price is the minimum requirement for any reversal to be taken seriously.
Okay, this is getting interesting. Severely depressed stock, highly volatile because of internal issues, and momentum is stuck in neutral but slowing its fall. Now we get to the central paradox of this whole report.
The battle between trend strength and trend exhaustion.
Let's start with the average directional index, the ADX.
Right. The ADX is a pure measure of trend strength. It doesn't care if the trend is up or down. It just tells you how strong it is. And NCL's ADX is at an enormous 51.92.
And for our listeners, an ADX above 25 is a strong trend. Over 50, I mean, that's just massive, an extremely strong trend.
It is. And unfortunately for anyone hoping for a recovery, that strength has been entirely downward. This indicator really reminds us how dominant and persistent the selling has been. It's a picture of entrenched bearish control.
That sounds like the final nail in the coffin for any rally. How do we square that, an incredibly strong downward trend, with the idea that a bounce could be coming? It feels completely contradictory.
And that's the art of technical analysis. You're looking for where the rules start to bend. In this case, an extremely high ADX reading, like 51.92, is often a precursor to what we call trend exhaustion.
Okay, explain that.
Think of it like a marathon runner who's been sprinting for the last 5 miles. They're moving incredibly fast, that's the high ADX, but at some point they just hit a wall. The trend has been so strong for so long that it often needs a pause.
So the strength of the trend is itself the signal that it might be running out of steam.
It can be, yes. And that suspicion of exhaustion brings us right to the indicator that is just screaming short-term bounce alert.
That is the stochastic oscillator.
That's the one. This indicator suggests the runner might be pausing for a drink of water.
So the stochastic is a shorter-term momentum indicator. The report gives us the values, K at 37.09 and D at 21.76. What are we looking for here?
The vital observation is that the K line has just crossed above the D line, and this crossover happened down in the lower momentum zone.
And that is the classic bullish crossover signal. It suggests short-term momentum has, for now, shifted to the upside.
It's the strongest piece of short-term tactical evidence we have. This crossover strongly suggests that the selling exhaustion we saw hints of in the RSI and MACD is now translating into an actual upward push. The report says this makes a bounce towards that 33 to 35 cent area highly probable.
So let's tie this all together. We have a deep bear market, a very unusual negative beta, an extremely strong downward trend shown by the ADX, and now an immediate signal of selling exhaustion from the stochastic crossover.
What a mix.
So what's the investment summary that comes out of all this conflict?
It means we have a fascinating separation between how a long-term investor should see this and how a short-term trader should.
Caution versus opportunity.
Exactly. Long-term caution is mandatory because of that SMA 200 and the negative beta. But for a risk-tolerant trader, the data defines a surgical, high-risk opportunity. The report's conclusion is crystal clear. NCL is a high-risk speculative buy candidate, suitable only for a short-term trading strategy.
So this is not a stock you buy and hold, not based on this report anyway. This is a quick, tactical strike defined by the levels we've just discussed.
Absolutely. And for anyone listening who's considering this, the report lays out the critical levels with extreme precision. The stock's at 404 cents now, so aggressive traders might see this as an immediate entry point based on that stochastic signal.
And where are they aiming for? Where are the profit targets?
Well, the first and most immediate resistance is the classic pivot point at 0.344 cents. If momentum is strong enough to get through that, the next major resistance level is up at 0.395.
So those are the targets for this relief rally.
Those are the defined targets, yeah.
Okay, but crucially, every high-risk trade needs a hard stop loss. If this reversal fails, where does a trader get out before the floor falls out again?
The vital line in the sand is the support level at 0.264 cents. The report really stresses this. You need a strict stop loss just below this price. If NCL breaks 0.264 cents, it signals a bounce has failed, and it could trigger a new, aggressive wave of selling.
What the report calls further capitulation.
Exactly. That 0.264 mark is non-negotiable for managing the risk in this trade.
And that really summarizes the dual reality of NCL, doesn't it? We've gone from the big picture doom, the stock trading miles below the SMA 200 at $1.73, the powerful ADX, all the way down to this immediate tactical signal from the stochastic crossover.
It's the classic battle between a deep, established trend and the early warning signs of exhaustion.
A brief window for traders.
And that tension brings us back to what I think is the most unique finding of this entire deep dive. And it's something for you to really think about as you process this data.
Go on.
The entire analysis we just did was based solely on technicals, the charts, the indicators. But we identified that this stock is driven by idiosyncratic risk, confirmed by that highly negative beta.
So we know how to trade the chart, but we still don't really know why the company's in this mess to begin with.
Precisely. The charts gave us the trade, but the negative beta is a flashing red light telling us the charts alone are not enough for a long-term view. So, here's the thought to leave you with. If this stock is moving based on internal failure, what non-technical, company-specific information, fundamental analysis, would you need to find out about NCL's operations, its legal situation, or its product pipeline to truly understand its long-term outlook, and to judge if this short-term technical bounce has any real foundation beyond just a few days of relief?
That's the critical limitation you have to address if you want to look past that 39-cent target.
That's the homework.